Welcome to County Portal, your simple source for local government services and public records. Let's get started.
How are tax returns calculated? It's a step-by-step process to figure out how much tax you owe the government or if you're due a refund. You begin by reporting all the money you earned throughout the year. This includes wages from your job, income from investments, or money from a side hustle. This total is called your gross income. Next, you consider certain adjustments to your income. These adjustments reduce your gross income. Examples include contributions to a traditional IRA, student loan interest payments, or health savings account, HSA, contributions. After subtracting these adjustments, you arrive at your adjusted gross income, or AGI. Your AGI is a very important number that many other tax calculations depend on. From your AGI, you then subtract deductions. You have two main options here, the standard deduction or itemized deductions. The standard deduction is a fixed amount set by the IRS, and most people choose this because it's simpler. Itemized deductions are specific expenses you can claim, such as mortgage interest, state and local taxes, or large medical bills. You choose whichever deduction amount is higher to reduce your taxable income the most. Once you subtract your chosen deductions from your AGI, the remaining amount is your taxable income. This is the portion of your income that the government actually taxes. Your tax is then calculated using tax brackets. The U.S. has a progressive tax system, meaning different parts of your taxable income are taxed at different rates. For example, the first portion might be taxed at 10%, the next at 12%, and so on, until all your taxable income has been accounted for. This calculation gives you your total tax liability. But you're still not finished. Now you look at tax credits. Tax credits are fantastic because they directly reduce your tax liability dollar for dollar. A $1,000 credit reduces your tax bill by exactly $1,000. Common examples include the child tax credit, education credits, or credits for energy-efficient home improvements. After applying any eligible credits, you have your final tax bill for the year. The very last step is comparing this final tax bill to the amount of tax you've already paid. Most people have taxes withheld from each paycheck by their employer. If you're self-employed, you might make estimated tax payments throughout the year. If the total amount you've already paid is more than your final tax bill, the government owes you a refund. If you paid less than your final tax bill, then you owe the difference. So, calculating your tax return is a careful process of adding up your income, subtracting deductions and credits, and comparing that final amount to what you've already contributed. Thank you for watching this video and learning about how tax returns are calculated. We hope this explanation made the process a little clearer for you. If you found this information helpful, please give this video a thumbs up and consider subscribing to our channel for more straightforward financial explanations. We really appreciate your support.